Welcome to The Explainer. Today, we're throwing on our expert analyst hats and putting a massive global insurance giant through the ultimate stock analysis stress test. We aren't just skimming quarterly earnings here. No, we're running Chubb Limited through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before capping the whole thing off with modern discounted cash flow and alternative valuation models. So let's just dive right into it.
Here's our roadmap. We're going to start with a quick Chubb company snapshot, then move through the Warren Buffett, Peter Lynch, and Benjamin Graham lenses. After that, we'll stress test the cash flows with a DCF model, and finally, synthesize it all for our final verdict.
All right, Section 1, Chubb Company Snapshot. Let's check their current vital signs.
To set the stage, Chubb stock is currently trading right around $327 a share. You're going to want to lock that number in your head, because everything we calculate, project, and stress test from here on out will be compared directly to that $327 price tag.
So what exactly are you buying for $327? Well, you're getting an absolute behemoth. A $128 billion market cap that generated $6.82 in core operating earnings per share in Q1 2026 alone. But look, for insurance analysts, the holy grail metric is the property and casualty combined ratio. And Chubb, they're sitting at a highly profitable 84%. Since anything under 100 means a company is making pure profit on underwriting before they even invest your premiums, and 84 is just spectacular. Add in their operations across 54 different countries, and you've got massive scale paired with incredible underwriting discipline. It's really the foundational pillar for any solid insurance investment.
Moving on to Section 2, let's look through the Warren Buffett lens to evaluate quality and the economic moat.
Now, Warren Buffett absolutely loves an economic moat, and Chubb's sheer global scale makes it incredibly difficult for new competitors to breach their castle walls. But, we always have to weigh that moat against the inherent, unpredictable risks of the insurance industry, namely catastrophes. Case in point, Chubb absorbed a massive $500 million in pre-tax catastrophe losses just this past quarter alone. So the question for a true Buffett disciple is always, is the core business model robust enough to absorb these unpredictable shocks without derailing that long-term compounding? Does the moat out-earn the risk? Yes, absolutely. Chubb passes the Buffett metrics test with flying colors. They boast a highly impressive 14% core operating return on equity, which tells us management is deploying capital super efficiently. And just look at this consistency, a staggering 33-year track record of dividend growth. That proves they can weather massive economic storms and still reward shareholders year in and year out. Plus, for Buffett's absolute favorite metric, owner earnings, Chubb generated $3.95 billion in operating cash flow in a single quarter. Buffett would love this business. But, as we all know, he also demands a wide margin of safety on the price.
All right, Section 3. Let's swap glasses and look through the Peter Lynch lens to balance growth versus price.
Lynch famously divided companies into distinct categories, right? Fast growers, turnarounds, asset plays, and stalwarts. To really understand our expectations for Chubb's stock price, we first have to ask ourselves, where exactly does an established insurer like this fit into his system? Well, based on the data, Chubb is the very definition of a Lynch stalwart. With a projected 5-year growth rate of around 4%, a stalwart isn't exactly going to double your money overnight. But they offer steady, predictable growth, reliable dividends, and a fortress of a balance sheet to protect your portfolio during a recession. Lynch loved having stalwarts in a portfolio specifically because they act as stabilizers when the broader market gets turbulent.
But Lynch didn't just buy great companies blindly. He demanded growth at a reasonable price, which he popularized using the PEG ratio. Chubb has an average PE of around 12.2. If we divide that by their estimated 4% growth rate, we get a PEG ratio of 3.05. Now, since Lynch generally wanted a PEG ratio under 1 to trigger a buy signal, 3.05 is just way too pricey for the slow growth you're getting. You are essentially paying a premium for safety and stability rather than aggressive expansion. So, through the Lynch lens, this stock firmly lands in hold territory.
Next up, Section 4. We're running Chubb through the Benjamin Graham lens, the ultimate deep value gauntlet.
First, we pass it through Graham's defensive investor checklist. Adequate size? Easily, with that $128 billion market cap. Uninterrupted dividend record? Yep, 33 years of payouts. Moderate PE? Yes, at 12.2, it is well below Graham's strict upper limit of 15. What about a moderate price to book? At 1.72, it's slightly over his ideal 1.5, but when you combine it with that remarkably low PE, it still clears the hurdle. So, defensively speaking, Chubb is an absolute fortress that would let a conservative investor sleep incredibly soundly at night.
Now for the absolute intrinsic value calculation. Graham's famous formula calculates fair value as the square root of 22.5 multiplied by the earnings per share multiplied by book value. If we plug in our data, an estimated annual EPS of $26.80 and a current book value of $189.93, the math spits out a hard intrinsic value of $338.42. For a deep value investor, this is it. This represents the theoretical anchor of what the underlying assets and earnings power are actually worth today, completely independent of Wall Street hype or future growth promises.
Moving into Section 5, DCF and Alternative Valuations. Let's apply some modern quantitative models.
To build a discounted cash flow, or DCF model, we have to forecast free cash flows into the future and then discount them back to today's value. The financial reports don't explicitly hand us management's internal discount rate. So, to bridge this data gap using industry standards for a massive financial institution with this specific risk profile, we must assume an 8% weighted average cost of capital, or WACC. We'll also responsibly apply a 2% terminal growth rate and a 4% near-term cash flow growth rate, which is based on their historical averages.
Now, good analysts never rely on just a single number. They build a sensitivity table. If we map out the fair value variations by tweaking our WACC between 7 and 9% and our terminal growth between 1 and 3%, we actually find that the intrinsic value doesn't swing wildly. Because the growth assumptions are fundamentally low and those baseline cash flows are so incredibly massive, the quantitative fair value hovers very tightly right around the mid-$340 mark. That tight clustering, it gives us a really high degree of confidence in the mathematical valuation of this business.
And backing this up, we have an alternative valuation model provided by Sure Dividend from our source materials. Instead of discounting future cash, they look at historical valuation multiples, specifically targeting a 13 times earnings multiple, and factor in dividend yield tracking. Using this alternative approach, their model points to a $348 fair value. Having multiple, completely distinct models point to the exact same price neighborhood is a massive green flag for any analyst.
Finally, Section 6. Synthesis and Final Verdict. It's time to bring all these puzzle pieces together.
Let's look at the fair value summary across all of our legendary frameworks. The Graham Deep Value formula gave us $338. Our modern DCF range clustered right around $340, and the Sure Dividend multiple tracking model gave us $348. We have remarkable consistency across entirely different valuation methodologies here. But do you remember our anchor price of $327? Compared to these intrinsic values, we are left with a razor-thin margin of safety. We're talking only a few percentage points of a discount. There is practically no room for error here if macroeconomic conditions suddenly deteriorate. Ultimately, when we integrate Buffett's love for the moat, Lynch's hesitance on the PEG ratio, and Graham's math, our final verdict as expert analysts is a solid hold. For value investors to get a sufficient 20% margin of safety, the stock would really need to pull back closer to the $270 range. But I'm going to leave you with this final thought. Chubb is a high-quality, lower-risk compounder that mints cash and raises its dividend every single year. Sometimes, paying a fair price for a wonderful business is exactly what a defensive portfolio needs. So, does this stalwart fit your personal strategy? Keep that in mind as you review your own allocations. Thanks for joining me on this explainer.